I am one of the most bullish people in crypto, and I still say don't just own crypto. Own stocks as well. Own property. Own gold. Diversify across different asset classes. And that's because of this chart over here. This is the correlation coefficient of different assets in the last 90 days. So for example here, Bitcoin to Ethereum has a correlation coefficient of 0.88, Bitcoin and the S&P 500 of 0.12, Bitcoin and gold of 0.2. Now what do these numbers mean? They mean how much do two assets tend to move in the same direction on the same day, relatively speaking. So the correlation coefficient is a measure between +1 and -1. When the correlation coefficient is at +1, it means the two assets move in sync all the time. So Bitcoin goes up, Ethereum goes up. So when you're very close to 1, the assets move at the same time. You don't get much benefit from diversifying, right? When the correlation coefficient is -1, then they always move in opposite directions. So Bitcoin goes up and your other asset goes down. This is ideal for portfolio diversification because then you could cancel out each other's assets, right? Let's say both assets go up over time, but they've got a negative correlation coefficient close to -1. You could simply just buy both assets and you would not be impacted by the price movement whatsoever. The ups of the one asset cancel out the downs of the other, and when both increase over time, you've got a risk-free, a non-volatile movement and capital appreciation. That's what you want. You want high return and low risk, and risk can potentially also be measured in price volatility. So +1 in the correlation coefficient is bad for portfolio diversification. -1 is very good. 0 is also relatively good because it means the two assets move completely independent from one another. One might go up, the other one might go down, but they also might move in the same direction sometimes, pretty much just random, independent price movements. And so let's go back to the table. If you hold only Bitcoin and Ethereum, you don't diversify whatsoever. If you hold some Bitcoin, some gold, and some S&P 500, you are diversifying quite nicely because here the coefficients are very close to 0. We even see negative coefficients between gold and the S&P 500 and gold and the Dow Jones. This is what you ideally want. And we can even look at this over time. So this is the last 90 days. This is the coefficient in the last 180 days. This is the coefficient in the last year. And here, for completeness sake, in the last 2 years. Overall, the picture isn't that different. Gold tends to be very lowly correlated. The correlation across crypto assets is very high. The correlation of crypto to precious metals or to stocks is relatively low. And so we get two benefits from this. The first one is, of course, you reduce the volatility of your portfolio. This is something that's very important, especially when you've saved up a lot of cash, right? When you've got maybe 3, 4, 5 years of annual income saved up and you've got that in a portfolio, you don't want to necessarily drop by 50% tomorrow by having it all in crypto, because it would take quite a while to get this back again. So the psychological aspect is one very important point. The second is you can potentially move from one asset class to the other if you see one of the asset classes outperforming a lot or dropping a lot. Now this is super valuable for crypto because it is so volatile. In other words, if you see Bitcoin crash, you can take advantage of this crash because you have something that's lowly correlated, maybe some gold, and you can sell that gold in order to balance out the portfolio again and get more money into crypto. You can take advantage of those drops. And the same is true the other way around, right? When crypto suddenly rallies and becomes a very large portion of your portfolio, you can sell off some of that Bitcoin and you can put it in the, relatively speaking, undervalued other asset classes. So a classical example would be that you're selling some Bitcoin in order to finance the down payment on a house. Now, how stable are those correlation coefficients over time? Let's have a look. A rolling 180-day correlation coefficient of gold versus Bitcoin. A very slight correlation, but it tends to be pretty stable around 0.1 and 0.2 roughly. We don't see negative correlation, but we also don't see correlation close to 1. Here's the correlation coefficient between the S&P 500 and gold. It tends to sometimes be correlated slightly more. So in other words, Bitcoin is a better portfolio diversifier than gold is, if your major holding is the S&P 500. And here we've got the S&P 500 versus Bitcoin. Used to be relatively highly correlated, is now decreasing in correlation. So Bitcoin is becoming a better portfolio diversifier with time. So yeah, you might not necessarily maximize your return by selling some Bitcoin and putting it into gold, but you are maximizing risk-adjusted return, and you potentially set yourself up to take advantage of these massive drops, which becomes especially important if your savings, a monthly cash flow that you can invest, when those aren't that big anymore to your overall stack because you have already accumulated a lot. So when your portfolio only consists of 1 or 2 months of income, that's not a problem. But once you go to 2, 3, 4, 5 years of income saved up, then you can only really take advantage of those drops if you don't have everything in one asset class. Then you have to diversify and you have to shuffle capital around. There's an entire playlist around mindset videos like this in the premium membership. When does it make sense to take profit? How can we work against confirmation bias? How should we think about time horizon and position sizing? So that's all in the premium membership. Feel free to check it out. There's a link down below. It's thebitcoinstrategy.com. There's also more information in the follow-up video over here. Looking forward to see you there. Bye bye.